Hello traders, so welcome to chapter 4 of this course. So we're going to be discussing market structure. So we have already looked at time and how it affects maybe our trading and the specific times of day and days of the week that we need to focus on. We have already looked at how we can define our price range, and we have also looked at what fair value is and the key fair value reference points that we can use, such as the fair value gap, the order block, and liquidity. So today we're going to be looking at what market structure is, and this is actually a foundational lesson that is going to assist us in maybe defining our entries, and it is also one of the confirmations that we need for framing a trade entry. So let's start. So what is market structure? So market structure is simply the flow of the market. So the ebb and flow of the market can be determined by market structure. So when the market, for example, is moving lower, how do we know that the market is turning? We can use market structure to know that the market may reverse from maybe that downtrend. And if it is going higher, we can also determine if the market is continuing to move higher and higher, or it's reversing. You can be able to determine from market structure. So I've defined here what a trend is. So a trend is simply a consistent direction of price movement over time, and market structure can actually tell you if the market is trending or not, because once we are coming to the end of the trend, market structure can be able to tell you exactly where the trend is ending. For example, if the 15 minutes chart is trending, we can know exactly when the trend has ended and the market is about to turn or even enter into consolidation. So there are two keys to consider when defining your market structure. So number one, it should occur at a key level, and number two, liquidity should be taken out fast. So these are the two elements that you need to really focus on when defining your market structure. So you don't want to just say that the market is turning without really referencing where it has hit or if there's any form of liquidity that it has taken out. So these are the two elements that you can use to determine a reversal in the market, and now you incorporate market structure to have a framework of how you can now say that this market is either turning or it's continuing higher or lower. So we have two types of market structure. Number one, I'm going to define what we call a shift in market structure. So in simple terms, this is just a short-term market structure. So this is usually a break either above or below a short-term high or low, depending on the direction in the market, that will lead to the market changing direction near term. So what I mean by this is that a short-term high or low is, for example, I can maybe use the 15 minutes to define. So if you have a short-term high or low, so we'll look at an example, but if you have a short-term high or low that is broken, when the market maybe was dropping, and then it was creating those highs, short-term highs, then it comes and breaks one of those highs. That is how you can define that is now a shift in market structure. So the reason we're saying it's short-term, it's because it could be intraday. The trend could be going down, but intraday maybe you can break market structure going up, but at the end of the day, you'll see the market resuming its original direction. But a break in market structure will typically occur in a 1 week level or maybe even daily, but it is more significant until it will take the market in a longer term perspective, maybe even say up to 3 months, sometimes even up to 6 months. So this is basically a shift in market structure that takes out significant levels in the market that will lead to a more extended move in the longer term. So as we've said, maybe the 1 week chart has broken maybe a higher or a low, then it takes the market maybe in the next 3 or 6 months in a certain direction. So this shift in market structure, as we have outlined, is one of our confirmation for hunting an entry opportunity once it is broken. So as an example, we have an example of a shift in market structure. So as we've outlined, this is usually a break above or below a short-term high or low in the market that will lead to the market changing direction near term. So for instance, in this 15 minutes chart of the Euro USD, we had the market dropping initially. This is during London. So the market was dropping into this key level. So there's a key level here. I've not outlined it here, but it was actually a daily order block that it came and hit. So once it hits that daily order block, and then it takes out liquidity. So those are the two significant things, or key significant things that we've pointed out that you need to be looking at before you consider a market structure shift or break. So once we take out that liquidity and we've hit that, in this instance, higher time frame order block, then we see immediate response from the market. So we're seeing the market immediately going higher. So when it was coming lower, we're seeing that the market was leaving highs, short-term highs, so including this high here. So this was a short-term high that was broken once it took out liquidity and hit that level. So it breaks aggressively. So you can see how that price action needs to be for you to consider it a market structure break or a shift in market structure. So this is a shift in market structure because it's short term. This is a 15 minutes chart. So once it shifted right here, it broke through. So sometimes you might find it come maybe just pocket above. It may not really close so much aggressively. But in this instance, we saw an aggressive move higher. Then once it breaks, you want the market to come back and retest maybe those reference points that we outlined as fair value reference points. So this is where fair value comes in. So you want, as much as it's broken, it doesn't mean you enter exactly maybe when it is this high. You want the market to come back down into one of those reference points. So I've outlined here an order block, which is this candle here. This bearish candle is our bullish order block. So that's what I've outlined. That's where the market came back and retested, and then the market continued higher to target this highs. So that is what we call a shift in market structure. It is more short term. It could be just this day going higher, and the market might later, maybe in the week, continue lower. On the other hand, the break in market structure is more significant. So that's why I've outlined here a weekly chart of the Euro USD. So I've outlined that this is basically a shift in market structure that takes out significant levels in the market that will lead to a more extended move in the longer term. So when I say significant levels, it's just essentially the short-term highs in this instance that are being created as the market moved lower. And then once those short-term highs, one of those short-term highs, once it's hit that key level down here, this is a monthly fair value gap. Once it hits it, there's a liquidity actually that was taken. You can go and check out in your charts the liquidity I'm talking about. So it took out liquidity and then it entered into this 1 week fair value gap. Then we're seeing the market now reverse. So once it took out, actually this high is the beginning point of the break in market structure, but this was more significant because we had this order block here, which was confirmed once this high was taken out here. So that's why we are saying this is a break in market structure, because in the next coming weeks we are seeing, actually this is not less than 3 months, we are seeing the market just go higher and higher from there. So that is the difference between the break in market structure and the shift in market structure. So actually, as an exercise, you can go back to your charts. Maybe you can identify different shifts in market structure and price action, annotate and journal as they were outlined here. And you can also identify breaks in market structure, annotate and journal them, just as I have outlined here. So thank you so much for watching. See you in the next lesson.